Hello my fellow investors and welcome back to another stock analysis video. Today guys, we are going to be analyzing the company Academy Sports and Outdoors. Now this company guys was actually brought by Tony Myers, where he pretty much just said, can you review ASO, which is this company? And I figured, you know what, let's actually do it because, well guys, we are getting into now the fourth quarter, and within the latter end of October, we are going to have a lot of companies to be looking into and also looking into their earnings as well. So guys, I actually would like to do a lot of those. So towards the latter half of October, I'm probably going to ask you guys to slow down on the recommendations. But for now, you guys can still recommend some and I will most likely do it. Just letting you know that towards the end of the month, I will probably slow down on them because I want to take a look at those earnings for all these other companies. But I digress. With that said guys, let's actually analyze ASO and see if whether or not at the current share price we would like to buy this company based on their fundamentals. So with that said, let's get started with this analysis. We are going to start guys with an actual dividend summary. Now this kind of surprised me. I was not expecting this company to have a dividend, and they do. Current yield of 0.36%, which ends up being 8 cents per share for an annual payout of 15 cents. Payout ratio is actually really small at 3.04, and well, they don't have a 5-year growth rate or even a dividend growth years. So let's actually see what's the case with this, because it actually isn't as bad as you think. It's not that they haven't been consistent with this, it's just that they just recently started paying out this dividend. So you can see here on the max, well, they recently just started paying this out on March 15th of this year. So it's perfectly understandable. They do have a lot of potential, hopefully. But as it stands, seeing that we don't have a 5-year CAGR or a dividend growth years, this might go in either direction, guys, right? They may be really good or they may just be all over the place with their dividend. Ex-dividend date passed as of September 14th. Payout date is actually going to be right now in 10 days as if I'm recording this, October 13th, and they pay their dividends quarterly. Coming into another calculator guys, we got the ticker symbol for ASO, market cap of $3.5 billion and a PE of 6.13. Current share price of $44.13. Now guys, this share price actually is now on the 52-week low. In fact, we're actually more towards the high end. As you can see on the 52-week range, $25.10 to $51.51. Now guys, just today alone on Monday, October 3rd, guys, the market pumped hard all over the place, and this company followed, gaining 4.62%, up $1.95. So yeah, it is what it is. I mean, they only went up like only $2, but still, it was a pretty big increase just across the board in the entire market. So it's actually not a case that this is a 52-week low, but we can still analyze to see if maybe this is a pretty good price to buy it at. Annual dividends, as I said, of 15 cents per share, ends up being $12 million being paid out in dividends every single year. And taking the 5-year average free cash flow and then subtracting this $12 million, they're still left with $350 million. It's actually not too shabby. And on top of that, guys, their last year's free cash flow is even more than that, of $585.55 million. These payout ratios are actually very, very respectable, and seeing that they don't have a lot of years of consecutive growth rates, this is pretty much just telling me that with a payout ratio of their last year's free cash flow of 2% and their 5-year average 3.3, it's telling me that essentially they might be able to continuously grow this dividend into the future. It makes it a little bit more safer than what it was just a couple seconds ago. Looking into these fundamentals, guys, starting of course with the net income, we got 5 years ago $58.5 million to 1 year ago, guys, of $671.4 million. Guys, that is a massive increase of 1,048%. Now, you all know how I feel about these types of increases, right? First of all, the one thing that I have to mention here is that essentially 4 years ago, they came down. They went from what, 58.5 million to then 21.4 million and then back up to 120 million. What caused this decrease right here 4 years ago? Definitely something for you guys to take a look at. But nonetheless, guys, on top of that, we also see here a massive jump from 2 years ago to 1 year ago, and even from 3 years ago to 2 years ago. Not as much, but still, you see it more 2 years ago to 1 year ago. And the reason for that is simply that, well, people were probably exhausted with COVID, and not in the sense that like they were exhausted with COVID, but just like mentally tired because of the whole COVID thing. People had pent up energy and they just wanted to buy stuff, and that's probably why, right? And that's essentially why. They are an apparel store. They do have a lot of outdoorsy stuff, so you can only imagine that after a year of being stuck in your house, people wanted to get out, and I think that's the reason why this happened. So it's understandable. I still don't necessarily like it, but I mean, it is what it is. I'm actually going to give this guys like a 70%. I actually would like to put it maybe like 65, but I'm going to go with 70, mainly because of just this little decrease right here 4 years ago, and again this massive jump over here. It's still on the 5-year, guys, an increase nonetheless, so I'm putting it at a 70%. Now coming into the free cash flow, guys, this one, it is really, really important, especially for that dividend. If you want this dividend to be sustainable, this thing needs to be sustainable as well. And of course, we have here, guys, 5 years ago, $48.7 million in the negatives, actually, negative $48.7 million, to 1 year ago of $597.5 million. That is a massive, massive jump of 1,327%, with an average of $362.12 million. Now, obviously, the big one here is that they were negative, of course. However, I actually don't consider that so much as like a bad thing. If they have like 1 or 2 years of negative free cash flow, but you could see that they are increasing it year over year and consistently increasing it year over year, to the point that eventually they got positive and then they continue to be increasing it consistently year over year, that I'm okay with. Now, the one thing I'm not okay with is this massive, massive jump in the free cash flow. 3 years ago, $201 million, to 2 years ago of $970.3 million, almost $1 billion, guys. And then, as you can see, this was not sustainable. They came crashing back down 1 year ago, back down to $597.5 million. So that's all over the place. This is actually right here. This is what worries me more than this negative $48.7 million. So for that reason, guys, okay, I get it's in the positive, but I don't like this thing that's not being consistent over here. I'm going to give it essentially like a 50%. Looking now into the revenue, we got 5 years ago of $4.8 billion, to 1 year ago of $6.77 billion, increase of 40.1%. Not too shabby. This is actually the one that looks the best out of all of them. At least it's not in the thousands of percent, which is insane. Now, we do see something interesting here, that essentially from 5 years ago to essentially 3 years ago, they were pretty much flat, right? I mean, they went from what, $4.8 billion to then $4.8 billion, right? They went down a little bit 4 years ago. Very, very consistent when it comes to this 4 year ago in their net income. So again, definitely something to take a look at, because something definitely impacted the revenue here as well as their net income. And then, well, we do see a nice steady increase after 3 years ago, going from then $5.7 billion in 2 years ago, and then $6.77 billion. Overall, guys, I'm going to give this a fairly good score at around like an 80%. You know, they did have a decrease here, which is, again, seen in the net income, and they have been consistently increasing. So you know what, I'm actually going to increase to like an 85%. I think they do deserve an 85% when it comes to the revenue. They've been doing fairly good. Now, looking at the total assets minus the total liabilities, guys, this is the one that essentially tells us whether or not the company is going to go bankrupt. And honestly, this looks really, really good for this kind of company. Currently, they're at $1.5 billion in this difference, and as you can see by this graph, guys, they have been consistently increasing it year over year. Now, we don't have 5 years of data for this, but you know, we do have 4 years of data, so it's good enough. I just put this one at 0, just so that way we don't get any errors. Essentially, not too shabby, guys, not too shabby. And so you can clearly see right here, average total assets is $3.5 billion, average liabilities is $2.5 billion, and doing this difference, we get $990.92 million. And you know what, guys, I'm gonna give this a 100%. This is actually looking very, very good as it stands. And now looking at the cash flow minus the liabilities, doing the exact same math with the assets minus liabilities, but instead of assets we do cash flow. This tells us whether or not the company's cash flow is able to cover their liabilities. Now, obviously, remember, we don't have 5 years of data when it comes to the assets minus liabilities. So you see here this value of negative $48.7 million in the 5 year ago. This is essentially the cash flow. So it is what it is. Just pretty much ignore it. So it is what it is. Looking at this from the 4 to 1 year ago, guys, you can see that yes, they are going down. However, from 3 years ago to 2 years ago, they brought it back a pretty good amount, right? 3 years ago was the lowest at negative $3.1 billion, and then they brought it back down to negative $2.3 billion. But as of last year, they did go down again, not as much as 3 years ago, but still to now negative $2.52 billion. Average cash flow minus the average liabilities, we get around negative $2.1 billion. I'm actually going to give this guys essentially like a 70%, maybe even like a 65%. Honestly, yeah, I'm gonna go with like a 65 to like a 60% or something like that. I'm gonna go with 60% just because the overall trend is down. They do have one instance where they did go up. That's essentially why I'm putting it as a 60%. And now for the shares outstanding. And oh boy, did this one catch my eye, because yeah, this one is very, very interesting when it comes to this company, guys. I mean, you're all looking at the graph right here. It's something, all right. Shares outstanding, guys, most underrated of all the metrics. Unfortunately, people do not look at this. Here on this channel, though, we look at this because we're value investors. We invest for 10, 20, 30 years. And this right here is the silent killer when it comes to investing. You want a company to at least be buying back shares when the share price is fairly low, and then to be issuing shares. Believe it or not, it's actually okay to issue shares if the share price is overpriced. Now, obviously, you want it to be buying back shares because the more a company buys back shares, essentially the bigger piece of the pie of the company you own. Remember, a share is a piece of a company. Now, this company, guys, is a decrease. It's a decrease, a huge decrease actually. 5 years ago of 228 million shares to today of 79.7 million shares. That's a decrease of 65.03%. And from the previous year to the current year, that is another decrease of negative 8.5%. Yeah, guys, that is massive. Now, here's the issue when it comes to this, is that this is something very, very weird that's happening here. Well, 5 years ago, again, 228 million shares. 4 years ago, they brought it down to 72.4 million shares. So that right there was a massive, massive decrease. Even more of a decrease than the current 5 year, which is ridiculous. And then 3 years ago, guys, they brought it massively back up to 228.3 million shares. And what's even more perplexing than this, guys, is that, well, you actually see this spike in the third year on February 2020. February, guys. This was before the whole pandemic actually started to go through. Now, in February, I do believe that it was ramaging. However, the real shutdown started in March, like towards the latter end of March. So, you know, their fiscal year ended, at least in 2020, in February. So they did not get the brunt of COVID, yet they still issued these many shares. And, you know, it's something to take note of. However, the following year, guys, they brought it back down to 91.1 million shares. And then they kept buying back to today of 79.7 million shares. This is ridiculous. And here's something also when it comes to this. When we see the discounted free cash flow, guys, man, do those numbers look weird. Those numbers look real funky. And the reason is because of this right here. They have such little shares outstanding that when you guys see that share price, you're gonna be like, why is that high? It's because they have little to no shares outstanding. And if they keep buying back shares, well, the share price should technically go up. And they have instances of buying back consistently from 2 to today. From 2 years ago to today. So yeah, we're also going to take a look at the book value as well, because this right here, this graph, these values are skewing the discounted free cash flow a massive amount, and you guys are going to see that in just 1 second. So overall, for this grade for the shares outstanding, guys, I have no clue. I really have no clue. I'm going to put it at like a 50%, just because I do not know what they're going to do. They have instances where they just spiked it, but as of 2 years ago, they're consistently decreasing it, so I don't necessarily know. And now lastly, when it comes to the cash and equivalents, they currently hold $400 million with an average of $248.1 million. So with all of that said, let's do a quick overview on all of their fundamentals. Starting, of course, net income, we gave it a 70%, free cash flow, 50%, revenue, 85%, assets minus liabilities, that was perfect, 100%, cash flow minus liabilities, 60%, and the shares outstanding of 50%. Overall grade, guys, of 67. So this one's actually pretty much up to you guys. As you can see, 67% for me, it's not passing, but you guys change the shares outstanding to a little bit higher, or the free cash flow to a little bit higher, and you're essentially at 70% for you guys. So please have this calculator and make your own assessment when it comes to this weighted grade, because 67%, guys, it could go either way with any small movements in these kinds of grades. But now for what we wanted to see. And guys, this is the discounted free cash flow. And as you can see, the current share price is $44.13, all good, great, and dandy. Usually we make 3 assumptions, and we use 3 different factors to come up with a target share price, not adjusting for debt, and then adding margin of safety. But just take a look at this base of the target share prices and the target share prices after debt. $237 on the dot. That is insane, and that is with a 10% required rate of return. Yeah, all of that is caused just because the shares outstanding are just that small. Now, obviously, if I put that they will buy back shares, this is going to get even larger because, again, less shares out there, the value should theoretically go up. So let's actually make some of these assumptions. So coming over here to the revenue growth forward, we see that it's going to grow at 7%. And the year over year has been 3.75%. So I'm not going to put that, not at all. So I'm actually going to put, guys, for the low assumption, revenue growth of like 2%. For the median, let's go to 3%. And for the high one, let's go 4%. For the projected share buyback, that is, I don't necessarily know. 65%, probably not going to happen. They had one instance where they issued shares and it was massive. So I'm actually going to put that they'll issue shares. And this is probably going to be wrong. I'll admit to this. This is probably going to be wrong. Let's say at like -1% for the low assumption. For the median, let's be at 0. And then for the highest one, let's be at 1%. Guys, the target share prices is, well, $252 for the low assumption, all the way up to $275 for the high one. Adjusting for debt, this has come down to now $238.86 for the low one to $262.37. And then with the highest margin of safety, guys, of 15%, you can clearly see that now the target share prices are like $203.03 to like $223. So yeah, this is pretty much all over the place. I don't know if I can trust these numbers or not, because again, this is being skewed by the massive share buyback that they have done so far. So basically, the discounted free cash flow is telling me that the company should be worth this. Obviously, I don't know. I actually do not know. So for that reason, let's get a second opinion using book value per share and tangible book value per share. And doing so, guys, looking at the book value, we can see that the current share price should be at $19.08. And when it comes to the tangible one, it should be at $1.03. I'll tend to believe more of the book value on this one than the tangible book value. That's just me. But yeah, guys, you can see these kinds of numbers are just all over the place. It really just depends as to what you believe. It really does. Obviously, if you believe that this is a $252 stock at the current share price of $44, this is looking pretty good, right? But again, the reason why this is being like this is because those projected share buybacks are just skewing everything. This is massive, 65% share buyback. That's insane. So it is what it is. And on top of that, they just have very little shares to begin with pretty good revenue growth. I gotta say, very good revenue growth. So as you guys can see, I have no idea if this is correct or not. So please do your own research when it comes to this company, because this one, it does have potential, but please do your own research. And of course, you can use my discounted free cash flow if you so wish to do so. Again, I just showed you guys my book value calculator. I also have a reevaluation calculator and even a dividend tracking sheet, which I should probably redo the videos on those. But if you guys want to track those dividends, you guys can have this dividend tracking sheet. All I'm asking for in return, guys, for this kind of content, as well as your recommendations, a couple of earnings report videos where we go over a company's earnings report when they come out. All I'm asking for in return, guys, for this kind of content every single day is just help me grow my channel. Like, subscribe, comment. Really does help it with the algorithm on YouTube, guys. That's really all I'm asking for. I'm not going to take on any sponsorships, and if I do, it'll be like food related sponsorships or something like that. I'm not gonna do any like affiliate links or anything like that. I'm just not really a fan. I like grassroots. Please just help me grow my channel. Like, subscribe, comment. It really does help. Now, lastly, let's actually take a look at this dividends. Now, 15 cents for an annual per share dividends is not amazing. And, well, putting in $5,725, this would get you 129.74 shares, which will result in around $19.46 in annual dividends. So there are better ones out there when it comes to dividend, but then again, they just started paying out this dividend, right? They don't even have a year yet. So they may have a lot of good potential growth. Really is a risk. But again, their fundamentals actually aren't that bad either. So take this as you will. Just be careful. Things could either go really good or go really bad. So all in all, thank you, Tony, for the recommendation on ASO. It was surprising. Honestly, I was expecting all this to be negative. Usually companies like these, I'm like, they're not good here, not good here. But you know what? 67%. Yeah, that could pretty much be a pass if you guys think that maybe their shares outstanding should be a little bit higher or something like that, right? So it's actually not too bad. It does have a lot of good potential in the future. This right here, I would actually consider this company a better growth company than most growth companies out there, because they at least have some fundamentals to back it up. The only one that's kind of iffy is their free cash flow. That's about it. And they can fix that very, very quickly. So I'm gonna say this one actually has potential. I like it. It's a risk, but it's a good kind of risk in my personal opinion. Obviously not financial advice. Please do your own due research. Every investment is the present value of all future cash. That pretty much does it for this video. Like if you like, comment, subscribe. It really does help with the algorithm on YouTube. You guys can follow me on my new tech sites. Link in the description below. So with that said, peace out. I'll see you all in the next stock analysis video.